Welcome to Illuminati Silver. We tell the truth about silver. Today is Sunday the 3rd of October 2021. And earlier today we published a video entitled Gold and Silver Regain Earlier Losses. What about next week? And we've placed a link in the description box below. Now the purpose of this video, albeit relatively short, is to take a look at inflation, or perhaps more importantly the media reporting on inflation, and how decisions by the European Central Bank, as well as other central bank officials, will have an impact not only on the US dollar value, but also gold and silver prices in turn. So let's take a look. Now, if we look at the main headlines from Bloomberg on inflation, we can see the following articles. Zimbabwe sees inflation as high as 53% at year-end, according to the Sunday Mail. 3 stock market rebuttals to the inflation Cassandra case. Fears about margin shredding inflation are palpable among corporate executives and Wall Street analysts, but equity investors are relatively sanguine. Inflation is far from transitory, Komal Srikumar warns. He's the president of Srikumar Global Strategies, and he warns that the inflation pressures facing the US economy do not seem to be transitory. Inflation could paralyze global policymakers, El Erian says. He is the Queen's College president, and he talks about the risks of rising inflation to global markets. Summers, this is former US Treasury Secretary Lawrence Summers, says that markets may be showing recognition that inflation won't ease after Treasury yields surge towards the highest levels since early 2021. He comments, once these things start, they sometimes have a tendency to trend. So I stand by my view that markets are substantially underestimating what's likely to happen to interest rates before too long. Hungry to boost pensions to offset higher inflation. BlackRock, world is coming to terms with higher inflation. He claims, this is Vice Chairman Philip Hildebrandt, he says inflation will settle at a higher level than we've been used to the last couple of decades. Wall Street Week, investors need to be on guard for inflation. Summers again says rising yields mean investors sensing inflation risk. And Chattanooga Mayor on infrastructure, inflation pressures. Tennessee Mayor Tim Kelly discusses the state of infrastructure and inflation pressures in Tennessee. Now, there are numerous other articles on inflation. I want to look at this one slightly. Euro area inflation surges to 13-year high with more to come, because there are people in the euro area at the top of the bank, the ECB, who have differing views about inflation in Europe. And this is important for one very simple reason. In the prime basket of 5 currencies, which tends to constitute the dollar index, the United States dollar is dominant. But running behind it is the euro. And so whatever happens to the euro to some extent has a counter-cyclical response to the dollar. So if the euro falls, then the dollar index generally, not always, but generally tends to rise. And if the euro rises, the dollar tends to fall in comparison. Now, it's not set in stone, but generally that's how it's tended more than 50% to work. And so whatever policies the European Union take to combat inflation or to combat any reduction in global trade could and will have an impact, at least as far as market makers, investors, analysts and traders are concerned. So let's go back to the 1st of October, because this is quite important. The headline was, Euro area inflation surges to 13-year high with more to come. Inflation in the euro area accelerated more than expected to the highest level in 13 years, adding fuel to a debate over how long the post-crisis spike will last. Consumer prices rose 3.4% in September, compared with an estimate for a 3.3% gain. Now you may think 0.1%, what difference does that make? But even the 3.4 on 3.3 is an incredibly high level. A measure stripping out volatile components, such as food and energy, climbed to 1.9%, a rate not seen since 2008. And that is crucially important because we've all seen the rise in food prices and energy prices anyway, simply because of the ramifications of the pandemic. And of course, we've witnessed some issues concerning natural gas. So if they are actually removed, you're still seeing higher levels of inflation. Price growth is driven mainly by effects related to the pandemic and the reopening of economies after long stretches of virus shutdowns. The European Central Bank expects a peak only later this year before a slowdown in 2022. Now, this is where some so-called notable individuals are basically claiming this is transitory. Yet supply chain bottlenecks in manufacturing are already lasting longer than many had initially anticipated, and surveys show companies increasingly trying to pass on costs to customers to protect profit margins. A deeper energy crunch is adding to the pressure. So what they're basically saying is, look, our recovery is not quite as great as it was. We're still encountering supply chain bottlenecks. Therefore, prices will rise because, as we all know, basic economics 101, if demand outstrips supply, the price goes up. Energy prices rose 1.3% in September and were up more than 17% on the previous year. Non-energy industrial goods were 2.3% more expensive than in August. Now, Bloomberg Economics says there's more to come. The headline rate could match its highest on record in November, fueled by the surge in energy costs and by prices for travel-related services. However, despite the headline increase, we see today's reading as an early sign that some of the upward pressures might be starting to alleviate. Now, European Central Bank President Christine Lagarde has said that she considers the current spikes to be largely transitory, and this was a term used frequently by Fed Chair Jerome Powell, except at his most recent public discussion. Now, Lagarde cautions against overreacting and prematurely tightening monetary policy. Some of her colleagues have voiced concerns that official forecasts will prove too low, though most still expect price growth to slow eventually. And that does seem to make an awful lot of sense, because of course, as the economy does open up, providing on the basis that we get this Delta variant under some form of control and that it doesn't adversely affect the economy even further, then of course some of that pressure, supply pressure, will reduce. But German figures on Thursday showed inflation at 4.1%, the highest in nearly 3 decades. That's 30 years. While that's driven primarily by statistical effects, the Bundesbank sees the rate remaining above the ECB's 2% target until the middle of next year. Now, a lot of people are calling that we are going to enter into a phase of deflation, and this is a discussion for another video. What we can say is we're not going to have deflation over the next 6 months for sure, and probably not over the next 12 months, but deflation is a possibility. It can actually occur, but it's not going to occur at this moment in time. A key factor that could entrench such elevated rates for longer would be rising wages that in turn risk setting off further price increases. And of course, you often have concerns that wage price inflation, which was really the bane in many respects in the 1970s in the UK, because you had unions with quite considerable power demanding ever-increasing wages and governments trying to introduce wage restraint, very often failed to do so in those days. And ironically, this is where Margaret Thatcher, like it or not, very cleverly introduced a policy of ramping up, and she did, ramped up unemployment, which not only eviscerated the trade unions, but also completely dampened down, at that time, any form of wage price inflation because people were desperate for jobs. And so we're not saying she deliberately did that, but it was a consequence of a quite stringent monetary policy. And so as a result, she, using the monetarist approach, she tried to remove inflation from the economic agenda. Isn't it ironic that it took a crash in 2008 to actually really achieve that to some degree? But of course, it's all based upon how you measure inflation. Let's have a little look now at someone who also believes that this situation is transitory. Bloomberg article dated October 2nd, 2021. ECB's Visco says price increases should be only temporary. Recent price increases are being driven by commodity inflation and supply chain snags should prove only temporary. European Central Bank Governing Council member Ignazio Visco said on Saturday. A speech commemorating economist Marcel Desecho, Bank of Italy Governor Visco said that for now there's little evidence of higher supply chain prices being passed through to consumers. Salary increases should remain subdued given the large number of people left out of work from the pandemic, he said, a view that supports the ECB's forecast that inflation will slow in 2022 after peaking in the coming months. The pressures on producer prices should prove to be temporary and not result in a persistent rise in inflation, Visco said. The ECB should act cautiously in countering shocks that appear to be only temporary in nature. Euro area inflation accelerated more than expected to the highest level in 13 years in September, while ECB President Christine Lagarde reiterated this week that she considers the current spikes to be largely transitory. Other euro area governors have been voicing increasing concerns. Visco acknowledged that the long-term impact of the pandemic, as well as that of digital and energy transitions on price dynamics, must be carefully examined by policymakers. But he stressed that in the short term, the ECB will look at all available options, including bond buying programs, to ensure that the euro area continues its exit from almost a decade of very low inflation. So this brief look at recent Bloomberg reporting shows that inflation is being heavily promoted. We have some officials claiming it's transitory and others claiming it may be more concerning than some are giving it credit. Those claiming it being transitory are, in our opinion, doing so as they realize that the only real measure the central banks have of combating it, therefore, is to raise rates, which is something they do not wish to do. Not at this stage, because they understand the ramifications for the equity markets and, of course, government debt repayments, which is why we shall go through a relatively lengthy process of tapering of bond buying first, in order to delay the inevitable interest rate rise. Something we should not forget, however, is that the market itself also determines rates, and when we see bond yields rising, this acts as a warning sign to central banks that they may not be in full control. Any prospects of rates rising or tapering being more severe than many expect will have a significant impact on the US dollar value, especially if other countries making up the basket of global currencies take a differing economic approach. This is why it's so important that we view and consider what other central banks do when attempting to forecast the future direction of gold and silver prices. Some claim we may enter a period of deflation moving forward, which is indeed a possibility. But that is not on the agenda for now, as it's going to take many months, if not well over a year, before inflation could even conceivably be viewed as controlled. And even then, there is no guarantee. What do you think? Do share your thoughts. Meanwhile, please give us a thumbs up, a thumbs down, subscribe, press the bell sign. Until next time. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views
of its owners.